Thank you very much for joining with us today. We're going to visit with you to recap July in the financial markets. As you know, the Standard & Poor's 500 here at the end of July is up 17% for the year. NASDAQ is up a little bit less, up about 15%. It had a slower period there, but it's now begun to catch up. And it's actually the big five stocks, the NASDAQ champions. I'm talking about the Hercules stocks. I'm talking about the Atlas stocks, Microsoft, Amazon, Facebook, Google, okay? Those are the ones driving the market right now in large part. Those five stocks are really accounting for a huge portion of that 17% S&P 500 gain. And as I mentioned before, in July, they've been outperforming the market and reestablishing their leadership. You have also the what we call the bodyguards of the market, and I'll get into that in a second, but the bodyguards of the market are the banks, the Russell 2000 of small and mid-cap stocks, and they are the transportation stocks. And the transportation stocks are up about 17% this year. The banks are up 25%. As interest rates have come off their January lows, the banks are up about 25%. And the small and mid-cap stocks, they were outperforming the Standard & Poor's 500 for the first half of the year. And in the past 5 to 6 weeks, they have underperformed significantly the Standard & Poor's 500. Why? Because of concerns about economic growth, about concerns over whether COVID, whether the Delta variant of the COVID will cause a significant slowdown. Also, higher interest rates tend to hurt small and mid-cap stocks more because they have to borrow more money than these big giant companies that are so rich and flush with cash. Oil, $73.62 as of July 30th, up about 53% for the year. The dollar up 2.5%, 3%. That has surprised a lot of people. They thought the dollar was going to be weaker, but people have basically seen the dollar as, number one, a significant yield advantage over German 7 to 10-year bonds that are negative 50 basis points. And there you have the 2-year Treasury here at the end of July, 20 basis points, 0.20%. The 10-year Treasury at 1.28%. And the 30-year Treasury, 1.91%. So that's a little bit of our market recap. I would be remiss if I did not bring in China. China's down 2%. They've been tightening monetary policy there. They've been reorienting the economy. And as you may know, they've basically been reasserting government control over the technology area and also over the for higher education area, where you have these tutoring companies that would help children as they prepare for this big national exam in China. They have come under some governmental supervision, some governmental sanctions, some governmental pressure, and that has basically put pressure on the Chinese stock market as a whole. And since China is about 40 to 50%, depending on which index you choose, of the emerging markets index, the emerging markets so far this year are up only 1%. Again, significantly underperforming the Standard & Poor's 500, up 17%. Now let's talk about the 5 pillars of our current constructive view. We are constructive and cautious at the same time. We are not against having some liquidity to put to work. It's been 9 months since you've had a 5% correction in the Standard & Poor's 500. So it's high time for there to be some sort of something. What do I think a candidate would be? Number one, the Fed tightening too quickly. We'll get into that in a moment. Number two, it would be profit margins. Companies have been reporting gangbuster profits here for the second quarter, up 70% year over year so far for the estimates of the S&P 500 according to FactSet and Refinitiv. So that will slow down. maybe 30% growth in the third quarter, 20% growth in the fourth quarter. These are rough numbers, but that's the essence of the message being given by corporate chief financial officers, chief executive officers on the earnings calls that I've been listening to. So the 5 pillars of the market are, number one, monetary stimulus. There you have the Fed, Chairman Powell, late in July at the end of their 2-day meeting, July 27th, 28th. He gave a press conference basically saying they're watching inflation. It was, some people thought it was hawkish. Some people thought it was dovish. My interpretation is he said we're just going to take it real easy here, and I think that's a part of our basic assumptions. We'll come to that in a second. Monetary policy is still a green light right now. Fiscal policy, that's this infrastructure bill, which they're talking about. It's working its way through Congress. $1 trillion. They started out at $2.5 trillion. There will be more behind it of social infrastructure after this hard assets infrastructure. Dams, roads, railroads, ports, airports. That's what the hard assets infrastructure bill is about. It's not the same because it's spread out. Infrastructure, it takes you several years to build it. Whereas last year's relief payments, trillions of dollars, $2 trillion in two different acts that Congress passed, $4 trillion goes right into people's bank accounts, and that was a much more stimulative, and it worked. It got the economy going. So the economic growth, basically for the second quarter, which was just announced. So the first is monetary, second is fiscal. Fiscal stimulus is slightly positive. I give that a yellow light. We'll see about what the tax package is that's associated with this spending package. Number 3, as I just mentioned, economic growth. Economic growth has come in a little bit lighter for the second quarter than people were expecting. Why? Because inventories were drawn down. That will be added to the third and fourth quarters as companies rebuild inventories. They had a lot of demand, but because of transportation issues, logistic issues, supply chain issues, they did not have the inventory they did not have surplus inventory, therefore they drew down the inventory. That subtracted from the second quarter number. Morgan Stanley and others were up at 10, 11%. The Atlanta Fed was at 8%. It came in less than that. Who cares? It was just fine. Economic growth, green light. Number 4 is COVID, and that is the Delta variant. Everybody's worried about Delta. The word Delta comes from the Phoenician word for a tent. So a delta is the top part of a tent that somebody would live in. That's that little triangle. That's where the word Delta comes from. Of course, it now means D in the Greek language. The Delta variant has scared a lot of people, but we would say they've mandated masks in certain places where you're going to have congregations of people. That is not the same as lockdowns. I think there's not the political will, there's not the social will to do a massive lockdown campaign. And of course, the Delta variant, it's more contagious, but it's much less lethal. It's serious. All of this is serious. And so masks are being mandated. But again, we put that as a yellow light. And then the next one is liquidity. So monetary, fiscal, corporate profits, and economic growth. Okay, COVID. And lastly is liquidity. And that is a bright green light. There's $2 trillion of excess liquidity still on households' balance sheets that's available to spend on goods, services, and investing. So those are the 5 pillars of the market. Now, what are our 3 assumptions before we wrap up here? The 3 assumptions is, number 1, we think the economic growth recovery is still going strong and it's going to be just fine. That's assumption number 1. Number 2 is the COVID. We think it's serious, but we do not think it will delay but not derail the economic recovery. And number 3, our assumption is the Federal Reserve knows all of this, and they are going to moderate and be very, very careful. They're paying attention. This is many times unlike some of the Fed actions in the past where they were way behind the market. They are attempting to stay in front of events and adjust the pace of their tapering. That's where they begin to slow down the purchases of government and mortgage-backed securities. And slow down the timeline and the timetable for their raising interest rates. Our best guess that's a 2022, 2023 event. The beginning of tapering, we'll hear more about that in the August 26th to 28th Jackson Hole Symposium of Central Bankers. Very likely to hear more about the pace and the profile of the tapering. And then you've got September 21st, 22nd. That will be the next meeting of the Federal Reserve. And my best guess, our best guess, is that they will announce then the pace and the amounts. And as of now, I think it'll probably be they'll begin to reduce. It's right now $120 billion a month. 80 billion in treasuries, 40 billion in mortgage-backed securities. At this latest July 27th, 28th meeting, they agreed that they're all one thing. They're not going to do something in mortgage-backed and then in treasuries. They would do them all together. My best guess is they would begin to taper by 10 billion in treasuries per month and by 5 billion in mortgage-backed securities per month. So they would go from 80 to 70 billion in treasuries, and they would go from 40 to 35 billion in mortgage-backed securities. So the third assumption is that the Fed, we think, is going to be very measured and very careful and very market sensitive in how they approach the withdrawal of some of that monetary stimulus. Let us conclude with two words, volatility. You can expect, we think, there will be more volatility in the second half of this year. Make no mistake, we've had a very calm and placid time basically for the first 6-7 months of this year. We do not expect that to continue. And again, that could come from international events. It could come from profit margin commentary in the third quarter earnings, not now. And it could come from something that the Fed says or does. So volatility is one, and caution is the second one. We've had a big run up in the market. There's a lot of enthusiasm, and in some pockets there are micro bubbles. The whole market is not a bubble, but there are certain micro bubbles in the market. So that's our second caution, our word that we would leave with you, which is the word caution. Thank you very much for listening. We look forward to seeing you again soon.